Sparking this sell-off here, Fed Chair Jay Powell's Jackson Hole remarks spooking investors, but some analysts think he can still navigate a soft post-inflation landing for the economy, and that a lot of the fears are already priced into the market. Joining us now with more, we've got Gaurav Mallik, who is the State Street Global Advisors Chief Investment Strategist. All right, so what is that soft landing going to look like, and how is that going to be navigated? Is it 50 basis point rate hike at this next meeting? Is it 75? What is your perspective?
Yeah, it's 50 basis points, we think, in September. Keep in mind that already we're seeing slowdowns occurring. From our estimates, we expect GDP growth in 2022 to come in about 1.5%, and then about 1% in 2023. Both are below trend. So I think the growth criteria or the growth slowdown is already underway. Now, notwithstanding the fact that there was certainly an easing in financial conditions because of the rally in stock markets in the last couple of months, we still think that financial conditions are indeed staying fairly tight, more so in Europe than in the US, but certainly in the US, they continue to be pretty tight. So the growth requirement the Fed has is already in play. We think supply chain pressures are easing, so that means there should be something to look forward to from an inflationary standpoint. We were encouraged by the Michigan Consumer Confidence Survey, long-term inflation expectations, again, remaining well anchored at a 2.9, higher, of course, than the past several years if you go back, but certainly remaining well anchored. So that gives us some confidence that the slowdown continues, Fed's mandate is being met. We could see inflation coming back down, and the Fed really moving from September onwards to more of a normal rate hike, which would be 25 basis points as we look towards the end of the year.
As we approach September, what changes have you been making to portfolios?
Interestingly, so our single largest active overweight call remains to be in cash and commodities. We just think it's a hedge against anything bad occurring, inflation spiking, any of those occurring. But incrementally, we've been adding more to Europe relative to the US. And we think the reason that makes sense is because in Europe's case, financial conditions are extremely tight, which means there could be potentially some positive surprise from ECB. The earnings have been very strong in Europe. In fact, sales growth has been better than the US in Q2. So we think there's some reasons for optimism there on the earnings front. And then valuation is very attractive. It is about the lowest level relative to the US we've seen in a long time. Frankly, the slowdown in GDP has not been as dramatic as we would have expected. So some reasons to be a bit more optimistic on Europe, but I would say the biggest overweight remains to be in cash and commodities.
Some of the commentary that we've received in the past with regard to the probability or likelihood of a soft landing has been to brace for impact. From Fed Chair Jerome Powell last week, we heard that households, businesses, individuals could see some pain inflicted and have to navigate that for a period of time. What do you believe that consumers should be preparing themselves for right now?
I think consumers need to be a bit careful. And, we've seen sort of savings rate, if you look at, so consumers are spending a bit more than the income that's coming in. The savings rate, about 5%, is about the lowest we've seen since about 2009. So I think that there is some reason for consumers to be slowing down a bit. But overall, incomes are going up. Overall, inflation seems to be coming back in line. So, and still a very healthy consumer.
We'll leave it there. Gaurav Mallik, State Street Global Advisors Chief Portfolio Strategist. Good to see you. We'll talk to you soon.